Hey, good morning once again, and happy Monday to all of our options traders out there. Hope everybody's coming off of a very good holiday week here and looking forward to a new year. And I thought this would be a helpful video to get you into a better mindset for investing for the new year. And I came up with the idea because I've had so many traders emailing or asking about how much should I invest in any given trade. Well, this is a whole concept of position sizing, and specifically what percent of your portfolio should you invest in a given position. Unfortunately, there are a lot of rules, and these rules typically don't state the assumptions. They just say it's a blanket rule, this is always what you do. Some of them are good rules, some of them not so good, but if you don't understand the assumptions behind them, they can really set some traps. So let's go find out some of these position sizing rules, where they can be a great help and where they can really do some damage. And as always, before we get started, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's take a look at some of the various rules that you will see out there. And again, I've put these in quotes because I'm always very hesitant to just stick to a rule for investing, because if they were really that good of a rule, there would be no other way to invest. Everybody would know these rules. So the first thing is to be a little skeptical of them. But the biggest point that I have, biggest gripe, is that people don't state the assumptions behind them and where the risks are. So the first rule that you will probably hear most often is what we might call the 1 to 3% rule. And that's just saying, yes, you can invest up to 1%, maybe to 3% of your portfolio's value. You might even hear up to 5%. But the idea is that you are going to limit how much you're going to put into a position. So if you have a $100,000 portfolio, you could invest up to $1,000 to $3,000 per position. There's another rule about stop orders, and it says if you use stop orders, you can increase the size of the position. Why? Because this stop order is going to block that risk. So, hey, if you've got a $10,000 portfolio, you can put it all into one trade as long as you have a stop order that's going to limit you to, let's say, $100 to $300 or 1 to 3%. There's another rule you'll hear about diversification, and that actually does the opposite. It says you could invest more than, let's say, 1 to 3% if it's a diversified position. There's another one that talks about volatility, and depending on whether it's a very volatile asset or not. So we'll take a look at that one. And then the last one has to do with whether we're talking about long-term or short-term positions. Now, again, before we get started, it's probably safe to say that when you hear this 1 to 3% rule, or 1 to 5%, whatever it may be, people are generally talking about short-term trades, far more speculative. We're going to buy a 30-day option because we think the stock is going up. That's mostly where these rules apply, but they can still get you into trouble. So let's take a look at each of these. Let's start with the 1 to 3% rule. So the rule of thumb, again, is saying invest no more than 1 to 3% of your portfolio's value in any one trade. So if you have a $100,000 portfolio, you could invest, let's say, $1,000 to $3,000 in any given trade or any given option position. Well, that's not a bad rule of thumb, but where it becomes a problem is for small accounts. And a lot of traders, especially who are new to options, will open up, let's say, like a Robinhood account, and they'll put $500 into it or $5,000. So even if you have $10,000, that's $100 to $300 per position. That would be 1 to 3%. And what this is going to do if you're trading options is it forces you to use out-of-the-money options. And out-of-the-money options have a very high probability of expiring worthless. So you can see the problem is that if you are doing short-term trading and you don't have a very large account, in other words, 1 to 3% isn't going to give you a lot of cash to deal with, it's going to force you to use out-of-the-money options. So the good news is that, yes, you can say that you always limited your losses to $100 to $300. The bad news is that's going to be the outcome nearly 100% of the time. So sure, it might make you feel good that you've limited the losses, but you're going to find that they are occurring almost every single time. And so that's a real dangerous rule to follow if you have a relatively small account. Now, is there a way that we can combat this problem? Sure, that's where options come in. If we understand options and strategies, consider using, let's say, an in-the-money vertical spread. And that can give you a very high probability for success without having to put a lot of money into the trade. So for example, let's say that you have a $10,000 account and you put 1% into an option trade. You say, well, it's $100. Not a whole lot I can do with that, especially if I want to buy some time. So you end up buying, let's say, the 120 call for $1. So here's our risk graph. There's our 120 strike at the bend, and there is the maximum loss at $1. The problem is that the stock is way down here somewhere, or worse. And you need that stock to make a monumental move just to get you at the money. And if this is the 120 strike that you paid $1 for, your break-even point is 121. That's the strike plus the amount paid. 120 plus $1 is right there where that line crosses zero. So you would actually need the stock to be at 121 just to break even. So think about that. You thought the stock was going up, you timed it correctly, you were absolutely 100% right, and you still lost 100% because it didn't get there quick enough. We've talked about that before with direction, magnitude, and speed. So to combat this problem, you might say, all right, I'm trying to limit this to maybe $100 or $300, but it's forcing me to use these short-term out-of-the-money options. Well, what if we use an in-the-money vertical spread? See, now I can go to more quality options. I can go to a $300 or $400 stock that can actually move. So it doesn't matter. Maybe this $100 call is trading for 10, but this 105 call, let's say, is trading for 650. So I spend 10, I get 650 back. I've got $3.50 into it. So, all right, maybe it's a little bit more than my 3%, but I can have a maximum gain because it's a 5-point spread of $1.50. So now, according to this rule, it looks like you might be pushing those boundaries a little bit, but remember, to get this kind of a relationship where you're spending more and making less with a vertical spread, the stock is up here somewhere. You don't even need the stock to move. It can rise, you're going to be fine, and it can actually fall a little bit down to this short strike, and you will still make the maximum gain. And yet, you might think that you're pushing these limits, but at least you're buying good quality in-the-money options, not these things that are so far out of the money that they have virtually no chance of ever becoming in the money. So if you want to stick to this 1 to 3% rule and you have a small account, consider using vertical spreads, and that will be a big help. Now, the second rule is about stop loss levels, and they'll say, well, you can invest more if you have various stops that you're putting into place. So we have two different types of stops. We have stop orders and stop limit orders. The thing to understand here is that neither is guaranteed to prevent losses. So this is just a bad idea. And yet you'll hear it a lot. People will say, oh, sure, put 75% of your account into one position as long as you have a stop order that might limit it to a $100 loss or a $200 loss. And that's the whole idea of these stop loss levels. Well, we've talked about these before, but when you understand how stop orders work, that is just a bad idea. So for stop orders, let's say that you buy 100 shares of ABC at $100, and you place an order to sell shares at a stop of 95, good till canceled. And what this means is that this stop price that you just placed is the trigger. That's all it is. That's the mistake that traders make. They assume because I have put a stop in at 95, I'm guaranteed to get $95 back. That is absolutely false. That would be a free put option. That would be way too good to be true. But the way that this works is that if ABC trades at or below 95 or whatever number you picked, the order is activated, or in the business it's actually called elected, and then it becomes a market order. And you should know that a market order means it's guaranteed to fill, we just don't know what price, whatever the current market price is in the market. But the problem is that stock could gap down. So you are guaranteed to sell, but you're not guaranteed to get 95. So now you can see the problem with using this as a risk management tool to say it's fine to put in a big position in your account as long as you're using stops. So for example, to see it visually, let's say that you sell at a stop of 95. Here's our stock at 100, and if it slowly works its way down, let's say to 99, it closes. Next day it's trading at 96, then it comes down to 95. At that point during the day, it's activated or elected, and of course it's now a market order, so you should get close to 95. And in that case, the stop order worked beautifully. It did limit you to a $500 loss. But that's not guaranteed, because here's what else can happen. We could have that stock work its way down like we saw before, but then it closes, let's say, at 96, but then the next morning gaps down to, let's say, 80 bucks. Bad news released before the bell. So what happens? It's now a market order. Well, now you just sold your shares at 80. That's now a $2,000 loss, not a $500 loss like you thought. So this is why if you ever hear this rule about, oh sure, invest a whole lot more as long as you're using stop orders, that's just a really bad idea. Now you might also think, well, wait a minute, there's a stop limit order, because if I specify my limit, I'm guaranteed to get that. That's not true either. In your broker's platform, you have to specify two prices. One is the stop price that we just talked about, and the second is the limit price. And that's just saying if the order is activated, submit a limit order, not a market order. So here's the way that a stop limit order works. You buy your 100 shares of ABC at 100 bucks. You place an order to sell 100 shares at a stop of 95, good till canceled, with a stop limit, let's say, of 94. Now this stop limit could be any number you want. Could be 95, might even be 96, could be 93. What you're saying is that if it gets elected, submit a limit order with this price. So most traders are going to allow a little bit of flexibility, a little bit of wiggle room that if it gets activated, that they will put this limit order a little bit below. So now if the stock trades at or below 95, that's your stop price, the order is elected and it becomes a limit order for $94. So now it becomes a live order to sell for any price greater than or equal to $94. So here's where these can go wrong. The stock is trading at 100, it slowly works its way down to 99, you still have your shares, it's at 96, you still have your shares, and then let's say it closes at 95. All right, the order is activated or elected, and now it's a limit order to sell at 94 or higher. So yes, in this case, you're going to get closer to 95. But what if you saw this? The stock slowly works its way down to 96, and then it again gaps down to, let's say, 80 bucks. And you're thinking, man, I'm so glad I put in a limit order because now I have a live limit order to sell at 94. Yes, you do, but guess what? You didn't sell. The market's currently at 80. So now you have an unrealized loss. It's true you didn't sell your shares, but it didn't prevent the loss. It just prevented you from selling the shares at 80. So now the question is, are you going to get shaken out of the position? Are you going to continue to hold? And will the stock ever come back? But the thing to see is that this whole idea of using stops as a way to gauge your risk limits is just a really bad idea. So what about the diversification argument? Well, we all know what that is. Don't put all your eggs in one basket. So if you have a diversified position or portfolio, you might even choose to put 100% into it. So let's say you have a $100,000 portfolio, 100% of that invested in the S&P 500 or the SPY doesn't make it exceptionally risky, even though you're investing far more than 1 to 3% of your portfolio, because you have a basket of 500 different stocks. And even in a case like this, you might say, well, let me put 5% in a relatively risky asset. Well, that's not really all that risky because you have a well-diversified portfolio. So in a case like that, 5, maybe 8 or 10% might not be too big if it's in a diversified portfolio. So another argument has to do with volatility. The more volatility you have in an asset or a position, really the less that should be invested. And most traders do the opposite. They hear that something like Bitcoin is going to the moon or Nvidia back when it was on fire, and they think they have to put everything into the position because they think they're going to make all the money in the world by the end of the week. And that just becomes a super risky position. So remember, the whole definition of volatility is that yes, it does have the ability to make more, but it also has the ability to lose more. So you're really just basically flipping a coin that you're either going to make it big or lose it big. And where's the risk management in that? So remember, if you are using your money to invest in a volatile asset or even in options, especially out of the money options, the more volatility that's behind that underlying stock, the less that you really need to invest. And then finally, long term versus short term. You can invest larger percentages for long term investments. And again, especially if it's diversified. So if you are putting a position in the S&P 500 into a leaps option that might be 2 or 3 years out, well, that's not necessarily that risky, even though it would completely violate the 1 to 3% rule. Because remember, when it comes to options, it's the extrinsic value that's the option. If you're using a deep in the money option, it's not really an option. It's just a substitute for the underlying stock. So I hope that little survey of different ideas and concepts for risk management helps, especially for the new year. I think we're going to have another really good year, especially for those who understand options and how to hedge, roll, and morph positions to manage risk. That's ultimately your best way. But if you get nothing else from this, be very careful of the 1% to 3% rule for short-term options. That's going to force you to use out-of-the-money options, and that's really not good risk management. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.